Hello, I'm Tyler Rudek, Chief Investment Officer here at Boyum Wealth Architects. Recent market volatility has caught investors' attention, especially after a strong run earlier this year. In this week's update, I'll walk you through three charts that help explain what's driving market moves and what it means for long-term investors. Chart 1 addresses market volatility and the recent pullback from last week. The market has experienced renewed volatility, including a sharp one-day decline in the NASDAQ following a strong jobs report. While that may seem counterintuitive, stronger economic data can actually increase the likelihood of additional Fed Reserve rate hikes, one of the key drivers behind recent market swings. Geopolitical tensions have also contributed to uncertainty. The key takeaway is that this type of volatility is normal, even during periods of strong overall returns. Next, we look at sector returns year to date. Despite the recent pullback, major indices have performed well this year, supported by strong earnings and improving sentiment. At the same time, the bond market has been signaling a more cautious outlook, with interest rates rising across the yield curve. This divergence helps explain why equities, particularly growth sectors, have become more sensitive to interest rate expectations. The last chart looks at future interest rate expectations. Technology and AI-related stocks have been particularly sensitive to changes in interest rates. These companies rely more heavily on future earnings growth, which makes their valuations more affected by rate changes. At the same time, expectations for Fed policy have shifted quickly from rate cuts earlier this year to the possibility of modest rate increases later on. Importantly, even in rising rate environments, markets have historically performed well, especially when economic growth remains strong. And that is it for this week. The bottom line is that recent volatility reflects changing expectations around interest rates and global events, but it's not a reason to fundamentally change long-term investment plans. Staying focused on diversification, portfolio balance, and long-term fundamentals remains the best approach. As always, if you have any questions, please reach out, and thank you for tuning in this week.